had a client call me a couple of years ago, and they said, "Oh, I got this notice from the state about some property that is in my name that is unclaimed." And I'm like, "Oh, why don't you send it to me?" So they sent it to me, and I said, "Let me go run an unclaimed property check for everybody in the family."
Mhm.
We got back $250,000 of unclaimed property.
Wow. Welcome to Planning Reimagined, a podcast from the planning experts at Rob and Glenn and RX Investment Partners for wealthy families and successful business owners. Hi, I'm Celeste Moya. Welcome to another episode of Planning Reimagined, where your wealth journey meets our expert insights. When you think of wealth management, you may think of characters like Bobby Axelrod on the HBO show Billions, always focused on those high-stake trades. But real financial success doesn't come from those risky plays. It comes from creating a safety net that gives you that long-term financial stability. In today's episode, we're going to discuss why holistic planning is so important to that long-term financial stability that's going to provide that financial success. We're also going to look at some investment trends and give you some key things to consider when you're looking for your own wealth manager. So make sure you stay tuned for some very insightful information. We're very fortunate to have with us today Phil Pilibosian, a senior managing director at U.S. Capital Wealth Advisors. And Phil has a rich background in managing traditional and alternative investments and in providing top-tier advisory services. He's also been a key player in the hedge fund world, a legal advisor on some high-stake financial deals, and now he's here with us today to share his wisdom. So thank you so much for being with us today, Phil.
Absolutely. Thanks for having me.
And then, of course, also joining us is our resident expert on advanced planning, Kris Stiegel, who regularly is tackling these complex financial scenarios for our clients. So let's just go ahead and jump right into it. Phil, I want to start a little bit with more of your background, because I really think it's going to help our audience understand why your expertise on this topic is just so valuable. Besides the fact that you do this every single day, your background is definitely unique. Your journey into the wealth management space is different than most wealth advisors. So can you share a little bit more about your background and specifically your transition from being a lawyer to co-founding Condera Advisors, which is now U.S. Capital Wealth Advisors?
Sure, absolutely. So yeah, I'm a little bit unique. Although I do run across people with similar backgrounds occasionally. I did a law degree and a business degree at Tulane, and went and practiced law for 4 years. At the time, I did a lot of private investment fund work for private equity funds and hedge funds, as well as a lot of corporate law, and sort of saw investments from that angle. Decided after 4 or 5 years to make the transition over to the business side and went to go work with a firm here in Houston, boutique firm, investment firm that was looking to start a private alternatives practice. And coming on board and having exposure to their client base and their needs as well as the alternatives. At some point in time, we actually took the companies that were inside of the larger firm, which was Redstone at the time, and spun them out. And so then I became the owner and operator of a broker dealer and a registered investment advisor, as well as a commodity pool operator. So it really afforded me the opportunity to see the inner workings of how those businesses run, which actually helps with the clients because knowing how those businesses run, most of my clients have assets spread across a variety of different investment institutions. So I sort of have some experience in terms of how to structure their dealings with those financial institutions because knowing what they can and can't do. So I've got a lot of different hats I've worn, and that is very helpful for the clients.
You got to see behind the
So
curtain. That's that is always helpful in our world. Kris and I have seen some of that too behind the curtain, and it becomes very valuable when you're sitting across a client. I'm sure you have some feedback on that, Kris.
Yeah, I mean, anytime we have, unique backgrounds or unique skill sets, and it's not just, us as individuals, but when we're coming together as a group, some of us are going to hear different things that the client is maybe experiencing and pick up on that thing. And all of a sudden you're going to have different types of solutions that come out for them that may not be, maybe in my wheelhouse, but maybe it's in Celeste's wheelhouse. And together, we can come up with some really interesting ideas. But yeah, it's always it's always fun to be able to utilize our backgrounds to help progress conversations. Like for me personally, I'm a math guy, so I just get to back and sit and do numbers all day long. So sometimes that comes into play. But I love working with people who have a legal background, because again, that understanding of how to actually structure something in addition to acquiring something is huge, right? Because you can't just do one or the other. You got to be able to do both. And so when you have that kind of a skill set, it's awesome to have at the table. And can I just say, by the way, I'm wildly jealous that you got to live in New Orleans for a while, going over to Tulane. There was one of the law schools that my wife was looking at. Very narrowly, almost got to live there. It's my favorite city in the whole world, I think. Sorry, Austin. It's true. So anyway, just want to say I'm really jealous about that. I love that city.
Food. I think that's another reason. So,
True,
other story for
true.
another day. But
Mhm.
so that actually takes us to kind of the next question that I had, Phil. So you saw what did you see in the legal and deal structuring space, that side of mergers and acquisitions, or M&A as we normally call it, and hedge funds that then prompted you to want to move into this client side management?
Sure. It's interesting. I didn't really start out with the goal of coming over to manage wealth for high net worth families. I started out with the idea of creating an alternative investment firm, which is what I was originally hired to do. And the opportunity set sort of started to change as I got into what I was doing. So, so why make the jump from one to the other? Look, being an attorney is great. There are some real pluses and minuses associated with that. The quality of people I work with in New York were top tier. It's a definite uh, interesting environment at the level of law that I was practicing, but it's a grind. Um, my nights were 12 in the morning, 1 in the morning, routinely coming home, and there was really no end in sight. I enjoy the business side of things. Like I said, I had an MBA. Prior to that, I was actually a salesman. I sold mainframe software. So I had an inclination to want to do stuff that was more business oriented, and starting an alternatives business was pretty easy for me just because I was doing that as an attorney for folks like TPG, the Bass family in Dallas, Deutsche Bank, a variety of players. Um, so um, that's what ultimately started in that process, and then I just sort of ran from there with the opportunities that were in front of me.
Yeah. And so in your practice, you know that you work with clients that are pretty diverse financially as well. A lot of it is for that high net worth, ultra high net worth client, but there's probably also some regular folks that are still building their wealth. So how has your background defined how you approach these clients, your problem solving approach to their very diverse needs?
Sure. Look, ultimately, it's a function of compounding their wealth, and of course, how much risk you want to take in doing that. And the client that's still earning and still has the career in front of them looks very different than someone who is retired and has sold their business and is looking to live off what they've made and then grow it and then of course pass it on to the next generation. And then there, of course, there's sort of the in betweens. Um, how you advise those people is very different. The stay rich strategy versus the get rich strategy, as I like to say. Um, all in the context of trying to sort of earn the most amount of return with the least amount of risk, differs from client to client. So, and on top of all that, you're trying to manage that in a tax efficient way. So in a way that hopefully we don't pay the government too much of what you make. Um, so bringing the background to that, it's from an investment standpoint, it's interesting. If you're not qualified, and by that I mean legally a qualified investor for certain deals, which implies net worth of $5 million or more, your tools are somewhat limited. You're limited to publicly traded bonds and stocks and insurance products and things like that. When you have amassed enough wealth, then you can start entering into the investments that are typically reserved for those who are of higher net worth. Um, and then your toolbox opens up quite a bit to income oriented investments where the rate of return is substantially higher than what you get in the public markets, as well as private equity, venture capital, arbitrage strategies in the hedge fund space. There's just a lot more you can do um, for those clients. So I think the advice kind of depends on where you sit in that spectrum of wealth.
Yeah. And well, with your background, the benefit is you get to see so many different clients, and probably there's still some common and recurring themes in those different stages of life that help you
Sure.
assist the other clients that come later, right, with the same kind of like set of things that they need or where they are in the planning stage of their life. So something that you said of, the get rich quick scheme. So that was actually one of the reasons why we started our podcast, was because we had so many clients that would come to us who are brilliant, just so brilliant in what they do, but they were getting their financial advice from YouTube, from the internet, right? I heard it on YouTube, so it must be true. And a lot of it was that false information. And, wealth management is the same. I'm sure you hear so much misinformation that's shared out there with clients, or clients come to you with, well, I want to invest in this because this is going to make me all the money. But at the beginning of this, episode, I mentioned that really it's the holistic planning that's going to be crucial for that kind of financial success over time. And that's something that I think it's not given enough importance. And there's many advisors that just don't talk about it because, to put it simply, it's much sexier, right, to talk about investments and alternatives than the other kind of planning that is necessary to preserve and to grow wealth. So I want to, from your perspective, if you can share with our audience, why is it so crucial for wealth managers to be able to provide this type of holistic planning versus just focusing on investments? And what does that really mean? Like, what does holistic planning really entail?
Sure. So again, I think it also depends on, again, where your clients are, where their life, where their net worths are, and where it's going. But for the clients that I deal with, a lot of it's about planning for where the wealth is going and how to minimize taxes you pay with that. And the investments that you make, whether they be risky investments, or less risky investments, should go in different buckets depending on that plan for their wealth in the future. One might think, I'll use a hypothetical $100 million client. That hypothetical $100 million client might spend $1 million a year of their income for expenses, and they have a very long time horizon, in the sense that most of their wealth is going to pass down to the next generation. So where you put those investments in the context of a plan is important, and having a plan to start with, it's important. So you can, if you don't understand uh, how to structure their estate in terms of where the assets are supposed to go and how they're going to be impacted by taxes, you could end up paying a lot of money to the government and not having uh, the assets grow to the maximum benefit on an after-tax basis. So you really got to kind of understand that. Okay, look, we've got this pot of money today. First of all, let's put it in the spots where we need to put it. This spot's for the next generation, and we tax plan that appropriately. This spot is for you to consume during your lifetime. This spot is for you to consume the use of during your lifetime. Think real estate, vacation homes, and whatnot. But it's really ultimately for the next generation. Having all that planned out can save that $100 million hypothetical client $20-30 million easy if you've planned it right. And we haven't even talked about strategies that can help minimize taxes so that you take advantage of step up basis at the death of the current generation before it gets passed on to the second generation. And then there's a whole other sort of area of to just talk about, which is the next generation, and how do we prepare them for the wealth that they're going to inherit, so that they understand how to manage that money, and they don't fall victim to the statistics, which are really bad as it relates to the wealth destruction that happens in the second generation and third generation.
Well, the other thing I think that you all do great is building in that flexibility into the planning, right? And of course, from our side, it's the risk management side, but clients have a vision or have a plan, and many times that plan doesn't exactly, go as expected, or maybe there were some, businesses that didn't perform as they wanted it to, or they changed their mind. I was just attending a family office luncheon yesterday, and it was a panel of folks that focus in the family office space. And one of them said, if my boss calls me today and says, hey, I no longer want to invest in this, I want to move it to that, then we have to do it and just kind of roll with it. And sometimes folks that have wealth, they change their mind about where they want to put their money. But also there's so many other things that can happen that are unpredictable through somebody's life. So in our world, between Kris and I, we're looking at risk management when it comes to life insurance. If there's a premature death, income replacement, disability, which is even a higher probability than somebody having a premature death. And to us, that's also part of the holistic planning that you all do and incorporate and advise and remind clients about, because it's really easy, once again, just to focus on this is what I want to invest today. This is the hot thing to talk about today. But it's not going to preserve that or protect them against some of the risks that are out there. And so, Kris, I'm sure you have way more to share on that too, because this is something that we deal with every single day too.
No, no, you're right. And we do deal with all of those every single day. I think another aspect whenever I think about, holistic planning and how we do our best to approach these things is when we can incorporate more of the family members into the conversation as well. If we're talking to one particular person within the family, they may not share the same long-term vision as maybe even their spouse or maybe their siblings who they're in business with, or maybe their children. And the more information that we as risk managers can have, the more information we have at those multi-generational spots, the better sort of a flexible, evolving plan we can create using structure and insurance and taking a look at investments and things like that, for the long term of the family too. So when I think about holistic, it's not just, yep, we got to develop a plan for the family. Yep, we need to make sure our investments and our insurances are mitigating everything that we need them to do. But it's also that, the plan lines up with, what everybody's really long-term goals are, well beyond maybe just one singular person inside the family.
But he said it's not about managing assets, it's about managing lives. And really it's about managing generational lives, right? Because there's so many other folks that are impacted long-term by the decisions of one generation. So Phil, part of being able to provide these comprehensive plans is having the right people on your team as well, right? And so that is the team that you bring to your clients. So what have been some of your priorities as you've built your team and grown your practice?
That's a great question. I think, my biggest limitation is there's only so much of me. So, having a team of people around me that can complement those strengths is important. And so we're a team of 10 within my team. And as an example, again, it's more investment related rather than estate related, but or planning related. But we have a fixed income specialist on our team that I don't have to worry about that anymore in terms of in my time. When fixed income makes sense for a client, we buy bonds directly for clients. I can pass that off to that person. Similarly, we've got several analysts that help me analyze private investments for clients. So that's helpful. Then, as part of the partnership with Robo-Advisors, which is recent for us, as our firm just recently got acquired by Eric's Partners, of which Robo-Advisors is a subsidiary. Now I've brought the whole capability of Robo-Advisors to the team, which is great. They're wonderful in helping me with strategize on estate, and we'll transfer insurance, all those things. So I've just multiplied leverage myself tremendously as it relates to that. So it's just about taking what I do today individually and bringing in other people that can do parts of what I do, so that I have other people to fall back on and to act as a sounding board for ideas.
And when our audience is looking for a wealth manager, I think that's one of the key things to look for is you don't want just somebody who is going to be very much just in this one lane of providing guidance. You really need to look at, are they really taking care of my full financial profile, my picture, my family, the legacy once again. And we'll reiterate that probably over and over today in this conversation, just because it's so important to look at it. Even if somebody feels like I'm not at the level of wealth to have those kind of conversations, decisions, you won't be there if you don't have somebody to get you be there or help you be there. So having that advice, that guidance, that team, and we're in the same boat when it comes to our team. There's expertise that Kris has, that other members of our team have, that I don't have, and so we're able to share that among the team. So it's really important to have that depth within your bench, if you want to call it that.
Sure.
Another,
we
sorry.
haven't actually spoken about it, but as part of the team, and you should always look for this if you're interviewing advisors, is part of the team is also legal counsel and CPAs, because they're ultimately doing the tax work and they're doing the legal work for some of these complicated transactions. And so when you are looking at an advisor, most advisors at a certain level don't have any of those relationships. But if you're advising the high net worth, the ultra high net worth, you should have a bench of 3 to 5 different firms that you can go to for advice in areas of law and or tax that are ultimately going to impact the clients. And their clients oftentimes are looking for people to help them with that, and to have that on your team is very helpful, even though it's not necessarily.
When as a consumer, it's also, it's reassuring if I can go to my trusted advisor and say, I need a CPA, and it's somebody you've already vetted, or it's somebody you've worked with, and you can vouch for what they've done, especially if they can help clients in the same situation as that one. Once again, depending on the varying levels of wealth or what their focus is. So I agree. That's super important to work with advisors that have those relationships that they can refer you to. Absolutely. So another key part of all of our practices is recognizing that clients are limited on time. They have a lot of choices when it comes to advisors, in all of the spaces that we work in. As a consumer, I can relate in the fact that they want seamless, access to seamless, efficient services. They want it to be quick and good and of quality. They want to have the best possible experience. And I think as consumers, we can all relate to that. But, the wealth management space is very diverse in the way that the firms are structured. We have some very large firms. We have more boutique practices like yours. So from your perspective, Phil, we can kind of take a step back and just look at big picture, the wealth management space. How do the boutique firms and the large firms compare? And is there any difference anymore? And just to kind of preface that a little bit even further, in the past, somebody might have said, I'm going to go to Goldman Sachs because it sounds prestigious. And they're a great firm. But is there a difference in what they're providing and what a more boutique firm like yours can provide?
Sure, that's a great question, Celeste. There is absolutely a structural difference in what a firm like Goldman Sachs, UBS, and nothing against any of those firms,
Mm-hmm.
Morgan Stanley, the large wirehouses, as they say, and boutique practices are structurally. Most of my high net worth family clients have looked to me for a diverse amount of advice. Um, Stocks and bonds and investments are, frankly, a very small portion of the advice they're looking for. Structurally, a large investment firm like Goldman Sachs, from an investment standpoint, pretty much is limited to pining on and giving you advice as it relates to products that have been approved by Goldman Sachs.
Mm-hmm.
So, as an example, and this is ad nauseum with most of my clients that are of that ilk, when deal flow comes to your clients, they look to you for advice on that. Because a lot of clients, especially those that are $100 million or more, and heck, even $50 or $25 million, get a lot of deal flow from a lot of people they know. This real estate deal, this private equity deal, and they're usually from friends. And it's no different than the superstar athlete that gets requests from a lot of their friends to fund this thing. And so they need help. They need someone to look at the deals to see if they're even worth pursuing. And then there's the bad guy aspect. They don't want to be the bad guy with their friend. They want someone else. Structurally, your advisor inside of a wirehouse, Goldman Sachs as an example, really can't give you any advice as it relates to that because the firms prevent it. Frankly, they're just not in the business of doing that, and they can't be. The liability that goes with that, and the sheer amount of resources that have to throw at that is just too big for little small deals within the context of the big shops that they run. To move the needle for Goldman Sachs, they have to be able to put 100 to $500 million of capital to work in something for it to make sense. Well, if someone brings client brings them a $500,000 investment offering, no one's going to look at that, and they're going to be forbidden to opine on that. So that's one, and that's a big thing because a lot of my clients really rely on me to look at private deals, and that's something you're just not going to get at a wirehouse like that. The other areas are more intangible, but they're along the same vein, and they're typically things that are reserved for family office uh, CEOs. A lot of large family offices have their own infrastructure with their own investment people, their own CFOs and whatnot. But when you're sort of in that 50 to 150 to $200 million range, and even higher in some cases, you don't have that infrastructure. So you're looking for your outsourced CIO, CEO, if you will. And some of that advice that you might provide them, in addition to what I just talked about, includes estate planning, and you'll find some of that inside of the large wirehouses that they have estate planning teams. But it might be the purchase or sale of a business. Um, I can share stories. I've helped clients sell businesses, literally, negotiated the transactions, acted as the go-between between the bankers and the lawyers, all that, review documents. It might be someone owns a business, they've got a CEO running it, and it's time for their employee contract to renew, and it's helping them negotiate that. These are functions that are typically reserved for an internal C-suite member of a family office that aren't readily there for people who don't have that infrastructure. So that's help that they're looking for that they're never going to find inside of a wirehouse. You can only find that inside of a small and boutique multifamily office where you've got enough people to do those services and with the expertise and the ability to do it. So that's a big distinguishing factor, which frankly rules out the wirehouses for a lot of clients.
So you can really roll back your sleeves and be that true, once again, use the word holistic advisor for your client, right? There's less of those barriers. Sometimes it's just even compliance barriers that they have to deal with to be able to provide advice at so many different levels. And don't get me wrong, those firms are great, right? We work with a lot of advisors that are at those firms. They also have their unique offerings, but we just want to make sure our audience understands that it's not necessary for everybody, to go to that type of practice to get the level of care, service, guidance, advisory that they need in the wealth management and in that holistic planning space.
I'll go a step further. A lot of our clients have relationships and accounts with those firms, but we still sit on top of that.
Mm-hmm.
Make sure that they're paying honest fees and we're either getting the best products that those firms have to offer.
That's a great point. Yeah, that it's not necessarily just a one-track type of situation. Kris, I don't know if you have any feedback on what you've seen with some of our clients in that space.
Yeah, I mean, the only thing I would really add is I think that nimbleness is wildly important for the higher net worth and the family office that we work with. I mean, a lot of times they don't want to just sit with a Goldman or UBS and things like that because they want to be able to look at other types of deals, big or small. They want to make sure that somebody's actually spending a lot of time looking at what they actually need and not necessarily what that firm can or is willing to provide based on their own balance sheet, right? So I think that most of the families that we work with really have a healthy appreciation for that smaller boutique-ish kind of firm versus trying to work with a wirehouse. It just doesn't really fit what they're looking for.
Being a boutique firm, though, it's hard, right, to be an expert on all things because going back to we each have our lanes. We all have the places that we probably enjoy more. Personally, wealth management is not an area that I focus in because I don't enjoy it, right? And so we have experts like you that we can rely on for that. But how has partnering and teaming up now, through your new relationship, through the firm, the acquisition of the firm, how has partnering up with firms like ours, like Rob and Glenn, and others that are provided through this relationship been beneficial to your practice?
Well, it's already, paying huge dividends. It's I have the need. So I have several clients that we've already done the sort of holistic wealth planning as it relates to estate succession. But there are a variety of tax strategies that you can employ if you structure things right to make expenses that were previously not deductible, which can be a lot in terms of tax savings. And having a group that's gone through this with their clients in Rob and Glenn, who has, be able to come in, introduce them to the relationship, and ride shotgun with me as we implement the same things that they've implemented for dozens of clients with my clients is great. And frankly, a capability I didn't have before. So it's huge. In insurance, the same thing. Working with people like Kris and others on potential insurance solutions as part of the estate plan has also been very helpful, rather than working with third-party brokers where, frankly, the relationship and the trust really hasn't been established, and there's a lot of conflicts associated with that, where I truly feel that I have a good extension of myself and that they're sitting on the same side of the table that I am with the client.
And on the other side of a table for us, once again, that what you do, what your team does is not what we focus on. And so we really like to come in and partner with folks that we can complement. Nobody's competing against anybody. If anything, we always want to ensure our clients are doing the proper planning first, what you can provide, what their estate planning attorney and their CPAs can provide, because then we can go in and truly assess what is that risk that we're going to manage. And so it's incredibly helpful to have other firms like yours that are collaborative, that want to partner, and that realize that we're just here to complement, what they offer. And Kris, I know that can talk all day about this.
Dude, we do. We talk a lot about this, and to me, I always think about it being like there's this magical thing that happens when you have high level advisors working at separate firms who are coming together to help a singular family. And then all of a sudden they start rowing the same direction. And like all of a sudden, incredible things start happening. The structures are starting to get in place and they're starting to make sense. And to your point, Phil, they're starting to save some income taxes because we've been able to adjust a few things. The risk management side is now suddenly taken care of, and it doesn't take away from, but it complements the wealth management side. And same thing on the wealth management side. We won't be looking at something from our end on the risk management side from an insurance perspective and go, well, wait a minute, like we've seen this happen before, going the other way, where we're like, why are you at these 3 or 4 different investment firms? If you take just even a little peek under the hood with my plebeian knowledge of investments, I look a little bit under the hood and go, they're all the same things. You're not actually diversified. Like that's not working. Like we need to get that over here fixed too. So that's why I really love, to your point, whenever we're all rowing the same direction, that's where a lot of magical things can happen. Diverse backgrounds, going back to some of the stuff that we were talking about before, people see things from a different perspective. But yeah, once everybody's going the same direction and working in tandem with the family on the correct side, the right side of the table, as you put it, Phil, with the client, you can really do some incredible things for families.
Because if we're all sitting, just yesterday I was on a phone call where there was an attorney, a financial advisor, the client, and there's things that we all mentioned individually that the others weren't thinking of, right? So we can all bring a little piece to the table to further protect what that client or further help that client in that situation. So I agree. It's just about that collaboration. So Phil, specific to your firm, what are some of the specialty areas that you and your team focus on?
I can back that up, like, 'cause I'll help you here because I always get a little confused whenever, not confused, but I always kind of raise my eyebrow a little bit when somebody says, "Oh yeah, we're into alts." I'm like, "Okay, great. What do you mean?" So I'll open that question there for you a little bit, and I'll let you dive deeper into some of the specialty areas.
Alternatives, right? What is that really? I mean,
Yeah.
that's a big umbrella. So we have a huge background in alternative strategies, and that is a wide bucket, and really that's really any private investment, but they can be broken down into investments in private companies, operating companies, or private equity. It could be broken into real estate, which is, if I do any less than 40 deals a year, that'd be a low year. So real estate, private credit, which is basically direct lending to borrowers as opposed to buying a bond that's publicly traded, and then what most people think of as hedge funds, which is another 30 different strategies that's inside the hedge fund moniker. And I've actually run 4 funds, still running 2 today, that invest in nothing but hedge funds, multi-manager funds. So I've seen a lot. Guys that work for me have seen it with me, and so for that high net worth client, again, this is the next level for those who are sort of passing the $5 million mark. it's when more tools open up for them to try to achieve their goals in a hopefully little bit better risk adjusted way, because you have more things to throw at the problem in terms of different types of risks, different types of asset classes that you didn't have exposure to before. So you really want someone who has the experience to evaluate those things, and also stuff available to just jump into, as opposed to having to rely upon the client for deal flow. So we have a wealth of solutions available across all the areas I just mentioned.
Well, there's risk tolerance, right, too, because there you have some clients that don't want that very complex type of investment. Maybe they do just want the vanilla stuff that is a little bit simpler for them to understand. So having access to all of it is important. Absolutely. I know earlier on you mentioned family office. And I know while you're not a family office, there's some services in that space that you guys offer as well to clients, correct?
Yes. So you can either have your own team of people doing everything, your taxes, your investments, your bookkeeping, those the big, and or you can outsource that. And that's what I like to think of us as, sort of the outsourced solution, along with your legal counsel and your CPA. So you don't actually have to hire all those things internally. Clients and people in general, once they hit a certain level of wealth as part of their estate plan, they quote unquote put in place a family limited partnership to sort of consolidate all their assets in one pool. But they don't go the next step of seeing whether or not there's a way to structure that from a tax perspective to make it a tax family office, as I like to call it, where you can start taking expenses that were previously non-deductible, I mentioned before, making it deductible. So that's an area where I think we can really help clients. And there are a lot of them out there where your typical family office, for lack of a better term, is in quote has the setup corporate structure wise, and they may have even hired a bookkeeper and a receptionist, which is really kind of enough. But they haven't gone the next step and structured it so they can get some real tax benefit of what they've done. So
And some of those family offices might be more lifestyle management at this point, right? And so you all can come in and complement them and really provide more of that investment, tax, estate succession type of planning if they don't have that expertise or just don't want to have to manage more employees within an office if they already have other operating businesses, obviously, that they're worried about, right? So it's a great complement to some of that team that they already have. So kind of just to button up the conversation on holistic planning, and so that our audience really understands why we think it's so important, because planning for your finances isn't just about your investments. It's about tax planning, which is a huge part of you're going to have that growth or not. We always say your money's going to go to one of three buckets. It's going to go to the government, it's going to go to your family, or it's going to go to, the community, nonprofits. And so planning it into the right buckets the way that you want takes that holistic planning approach now when the person is living, so that they can make sure and direct that money where they want it. So that's really what we mean by holistic planning, why it's so important to find advisors that maybe even if they don't have that in-house expertise, they have other advisors to connect with to provide it. But now we're really going to shift gears here and talk about something completely different, but equally as important, because we have this, newer generation of investors that are looking at things very differently. Robo-investing, technology, all of this has just dramatically changed the market. It's changed how people of all ages are investing, but we've definitely seen it with younger investors. So how has the robo investing technology, some of these new investment avenues, that we can talk about those in a minute, but how has this impacted your firm, and how do you see wealth management kind of future proofing against some of these that are great, but can also be not utilized properly without the right expertise in the investment space?
interesting question. I really don't see it impacting my business much at all. Really doing what we do for all the things we just talked about is really not susceptible to sort of a robo advisor. Stocks and bonds tend to be a fairly commoditized advice product for clients, especially with the advent of indices. And so that is very little of the value add I think you get out of a group that focuses on the areas that we focus on. And the areas that we do focus on are things that really you can't robo.
Yeah.
Well.
Yeah. Absolutely. Yeah, the robot's not going to call you and give you the right tax advice, right?
No, and
Yeah.
frankly, I let's give another example. I always like this example because it's true with me. It's so off the beaten path. I had a client call me a couple of years ago, and they said, "Oh, I got this notice from the state about some property that is in my name that is unclaimed." And I'm like, "Oh, why don't you send it to me?" So they send it to me, and hmm, let me go run an unclaimed property check for everybody in the family.
Mhm.
We got back $250,000 of unclaimed property.
Wow. That's crazy. Yeah.
Remember, it's not going to happen, right? It's just like it's things like that. These like one-off things. It's intangible to sort of for me to describe what they are, but they are different. The family is looking for someone that can draw on a diverse set of experience, and harness other resources
Hmm.
to do what they otherwise would find very difficult to do themselves or don't have the time to do it. And frankly, from a practice perspective, it creates a wonderful relationship because you become very, very ingrained in the family, um, and they rely upon you for a lot of things.
Well, and that's an important point. Planning is not linear, right? So you're really bringing in from all the pieces. Kris and I have been working with a client that very well very well. His business has grown so much. He has all these assets, but very illiquid, hasn't done the right planning. And if you just look at it high level, he's doing fantastic. But when we peel back the layers, he had so much tax exposure because nobody had ever advised properly. So if he's just, going to online and investing, there's nothing that's going to stop him from keeping going. But behind the scenes, nothing had been structured properly to protect him from a tax perspective. And so to your point, that's something that not having that human touch, that real life advisor is going to provide. Kris, you look like you have some thoughts.
Yeah, no, totally. I think that, like, for me, even for our firm, I think that that's the future proofing itself, right? It's being able to have that person to person or family to family relationship, whatever you want to call it, that relationship that allows you to, converse and really understand their entire world, the investment world, the risk management world, the estate planning world, insurance, whatever it might be. There's not a robo investor that can go in and do that. So we have to get all of it a step back and said, holistic planning is wildly important. I think that's how, all of our firms future proof themselves because one, we do provide that holistic planning. And if we were missing a piece, then we'd go get best in class advice on those things, right? To help make sure that we are buttoning up everything as much
Yep,
as much as we
absolutely.
can.
So, I mean, I just think that there's so many studies now that have been done or surveys that have been done with clients too, where it's clear that most of them still want that human touch. Or even if they start by looking and getting their advice on YouTube or on the internet, at the end of the day, they really rely on their advisors to be able to guide them. So kind of just to expand a little bit on some of the trends, and to kind of wrap up this conversation as far as the trends too, we've seen that more and more people are having access to investment options that maybe in the past were thought of only for the wealthy, right? So we talked about alternatives and hedge funds. Phil, in what you're seeing, what do you think is driving this kind of increased accessibility to these types of investments?
I think there's a lot of product that's been packaged out there that it's been made available to the accredited investor, which is the person with $1 million or more of net worth, that is especially making its way through the larger wirehouses. And $1 million today, as amazing as it might seem, is a pretty easy threshold to meet for a lot of people, where that wasn't the case a while ago. And so the proliferation of these products, I think, directly tracks fees, and these products tend to be heavily feed. They're very retail in nature, even though they are for people that are worth $1 million or more. And they're products that I tend to avoid for that very reason. I think the proliferation of them is meant to sort of attract people into something new that's other than stocks and bonds. But unfortunately, the very nature of the structure dictates a lot of operating expense and fees associated with it. So you end up paying a lot to be in something that, if you can go through a more boutique solution where where you're not getting the Blackstone product per se, the B REIT, where maybe you're getting a different group that hasn't layered all the fees into it, and it's truly a private partnership. That would be a better solution. So there's a lot of products out there that are being created because they generate a lot of fees for the people that create them and the people that sell them, and those are the products to avoid.
Going back to that whole idea of it's just like the democratization of, alternatives. I think that you kind of hit it on the head. All that really means is that a lot of firms have packaged things up nicely and neatly and have kind of put it out there to the retail investor, where the other side of that coin is better price and probably better investments outside of those outside of those packaged products, right? And so, like, yes, it's been democratized because it's easier for people to get because it's been packaged up nicely, but the reality is they're more expensive, and you're probably getting a much better touch if you're using a holistic, more boutique firm that really analyzes these things and isn't just selling a product.
And Phil, I don't know how much this comes up in your practice with the type of clients that you work with, but social media, going back to our clients getting a lot of their information off of that, seems to put things out there, the GameStop, the meme investing, things like that that's happening that is creating unrealistic expectations. So when that does come up in conversation, or if it does in yours, how are you managing client expectations around that? How are you educating them on this information?
It doesn't come up as much as you think. I think clients see through sort of some of that stuff pretty easily. My clients don't tend to get caught up in hype in terms of things like that. They sort of see it for what it is. So I really haven't had much experience with that in terms of having to deal with it. It's hard for me to respond quickly.
That's right. We get that. Yeah, no, that is good. That means your clients are really well educated. Not that, I mean, people who are investing in those types of things are probably pretty well educated too. But there's this, like, we call it, there's sort of two aspects to this. A good friend of mine calls it unsupervised internet research, and that's where inevitably somebody goes out and they find something. Oh, well, what is this about? And then I come back and say, no, that's, I call it shiny object whack-a-mole. I'm like, stop it. No, that's not what you're actually trying to do or accomplish there. So anyway, it's I think it's pretty. I think for me, it's actually kind of fun when people go out there and do research, as long as they call me before they go and invest in something like that or buy something. So
speak for themselves if they're not doing it right? If they don't have the right expertise or the right guidance behind it, unfortunately. So Phil, in every one of our episodes, we try, if we can have time, and we have a few minutes left today, so we try to debunk some of the myths that are out there. Pop culture many times portrays wealth managers as being kind of opportunistic, right? There's characters like on the HBO show Billions. There's Bobby Axelrod, who always seems to be scheming something up, which makes great show for Hollywood, but maybe not so accurate when it comes to real life planning. So when clients hear holistic planning, they may start to think, well, that just means my wealth manager wants to charge me more fees. But what do you have to say to that, as far as that portrayal and just it being a way to charge more fees to clients?
No, that's an interesting statement. Holistic management actually probably ends up in the clients paying less fees, right?
Mm-hmm.
One of the things I probably should have said at the outset, when you're looking at an advisor to provide holistic management, one of the things you want to make sure is the technology pack they're bringing to the table, because as a holistic manager, you really need to be able to capture and stay on top of every investment a client has, not just their stocks and bonds. So that, it could be any asset in their portfolio, from their house to a vacation home to, an investment in a real estate deal, whatever. I mean, I literally have clients with 400 line items outside of stocks and bonds. That's important. And as part of that, coming in, and usually the fees that are paid by clients tend to be fixed fees as opposed to percentage of net assets. As part of that, you're going to take a look at and scrutinize everything that the client's paying from a fee perspective to other people. So there are instances where you can come in and essentially save the client money, and they actually don't pay anything extra for you by eliminating fees that are unnecessary, especially as it relates to stocks and bonds, paying someone 1% to go manage a portfolio of stocks when I can effectively do as well, if not better, than XYZ broker or investment manager that they've hired to run a portion of their portfolio that to keep up with the S&P that doesn't do that, and they're charging them 1% for that. There are a myriad of solutions that we can put them in that not only will do that, but will actually throw off tax losses to help offset gains. I mean, there's so many different strategies you can use, but the bottom line, the biggest answer to your question is no, that's a big myth. In fact, you might actually up your level of service tremendously and actually save some fees in the process.
You might find some unclaimed property too, right? $250,000.
We're right there. That's 2 years worth of.
I'm going to have to call Phil. I did a search in that in Texas because I spent a lot of time there. And I got $150 back last week. So.
There you go.
Well, that's probably because you're pretty astute about making sure all your everything going where it should be going.
That's true.
Absolutely. So yeah, just to reiterate, planning properly actually can save clients a lot of money, a lot of headache, probably a lot of arguments with family members in the future too, and just preserve that wealth for future generations. So
we had a client, and this is another war story, that came to us, and they had a portfolio of structured notes, which I won't go into what that is, but they were with a big wirehouse, and the advisor at the wirehouse who sold this portfolio, and it was a fairly large portfolio, was it was a 2% payoff to the advisor, and it was roughly $200,000 a year. We looked at it over the course of the 3 years the client had the portfolio. They had made nothing for the advisor.
Of course.
And so we eliminated that fairly quickly. I mean, that more than paid. That elimination, A, resulted in better performance for the client. B, more than paid for our fee.
So don't just find advisors, find good ones that aren't just charging you for things that aren't really giving you a good return or long-term return as well. Well, thank you so much, Phil. This has been great. We really appreciate your time. It's been a great, insightful conversation. And really thank you for highlighting the importance of, what a true good advisor does from a holistic planning perspective. If our audience wants to connect with you, continue this conversation, what's a good way for them to connect with you?
Sure, they can always call me. And I don't want me to give my number over the podcast, but I will if you like.
We will share. We will also include your contact information, but sometimes people prefer email or phone. But
email is always the best. If you want to email me, it's and then if you want to share that, but it's PJP Paul John Paul at uscallc.com. It's the uscallc.com. That's probably the safest way to get a hold of me. I'll make sure that I respond. I'm pretty prompt when it comes to that.
Wonderful. Well, thank you so much again, Phil. Thank you, Kris, sure. As always. It's always great to have you on here and for us to share our insights and our perspective from the Rob and Glenn. And that's a wrap for today. Thank you so much for joining us. Don't forget to check our show notes for our guest contact information, links to other resources. If you've liked what you heard today, please make sure you like, subscribe, and share our podcast. So as always, thank you so much for joining us for another episode of Planning Reimagined, where your wealth journey meets our expert insights. See you in the next episode. Thanks for listening. Don't forget to like and subscribe, and please be sure to follow on your favorite podcast player. To connect with us, you can email us at hello@robandglenn.com or schedule some time with us via the link in the show notes. You can also find us on Instagram and TikTok at Hello Rob and Glenn.